Welcome back to the deep dive. Today we're looking at employee benefits in Kenya and, how they work with the tax system.
Right.
We've got some really interesting documents here that break down all the different types of benefits and, what kind of tax implications they have. So basically, we're trying to figure out how to get the most out of those perks without running into any trouble with the tax man.
Yeah, absolutely.
Hmm.
It's like trying to find that sweet spot,
Yeah.
where both the company and the employee can benefit.
Okay, let's dive into this. The first thing that jumps out at me is employer-provided housing. It's a pretty common benefit, especially for certain jobs, but these documents are saying it's not as simple as it sounds when it comes to taxes. So what's the catch?
Well, the thing is, in Kenya, if a company gives you housing, the value of that housing is actually considered taxable income. It's not, just a freebie.
Really? So even if I'm not getting extra cash, that company apartment is still like adding to my tax burden. That seems a little counterintuitive.
Yeah, I know it can feel that way. But there's a reason for it, right? They're trying to be fair and prevent loopholes. Imagine if companies could just offer really low salaries and then give everyone these amazing houses to avoid taxes. That wouldn't be very equitable.
Yeah, I see your point. That would create some problems. So how do they actually figure out how much of that housing benefit is taxable?
So they have this, I guess you could call it a three-pronged approach. They look at three different calculations, and basically the taxable amount is whichever one of those three calculations is the highest.
Okay, so they're really covering all their bases to make sure they're accounting for everything. What are those three calculations?
Okay, so first, they take 15% of your total income, not including the housing value, of course. Then they look at the fair market rental value of the property. And finally, they consider the actual rent that your employer is paying for the property.
Oh, okay. So whichever of those numbers is highest, that's what gets added to my taxable income.
Yeah.
But wait, I noticed that the document mentions different percentages for different types of employees. Why is it 15% for some and 10% for others?
Yeah, good catch. So that's where your specific role comes in. If you're, say, a full-time director, you're going to be in that 15% category. But if you're an agricultural employee, living on a plantation or something, it's only 10%.
Interesting. So where you work and what you do can actually change how much tax you owe on your housing benefit. It seems like agricultural employees get a bit of a break there.
Yeah, there are specific provisions for certain industries and situations. It's kind of like that in a lot of tax systems, right? But the main idea is the same. They're trying to figure out a fair taxable value for that housing benefit based on your individual circumstances.
All right, so we've got these different calculations depending on your job. Are there any other like weird quirks or exceptions we should know about with this whole employer provided housing and taxes thing?
Well, yeah, there are definitely a couple of things to keep in mind. First, there's this thing called an arm's length agreement. Basically, it means that the housing deal has to be fair, like a normal market transaction.
Gotcha. So they're making sure there's no funny business going on.
Right. Like, let's say a family member of the company owner is renting the property at a ridiculously low price. In that case, they're going to use the fair market rental value, no matter what those other calculations say.
Ah, so they're closing that loophole right there.
Yeah,
Makes sense. They want to make sure everything's legit and prevent people from getting too creative with their accounting.
exactly. And then there's another thing to consider. What happens if you only get housing for part of the year? Let's say you join the company midway through.
Right.
Well, they actually reduce the taxable benefit proportionally. So if you only had the house for half the year, you'd only be taxed on half the value.
Oh, okay. That seems fair. So they're not just assuming you had the benefit for the entire year if you didn't. What about, like, if I'm paying part of the rent myself? Does that make a difference?
Yes, definitely. If you're contributing to the rent, they deduct that amount from the taxable benefit.
So it's not just a one-size-fits-all situation. They look at how long you've been in the housing and if you're chipping in on the rent, which makes sense to me. But now I'm thinking, knowing all this, what can companies actually do to make this benefit work better? For them and for their employees, I mean.
Oh, that's a great question. There are actually some clever strategies that companies can use. For instance, if it's possible, they can try to provide housing that's on agricultural properties, like plantations.
So is it like location, location, location applies to taxes too?
Pretty much. By taking advantage of that 10% rule we talked about, they can really lower the taxable benefit for themselves and the employees.
Smart move. What other options are there?
Well, another thing is to encourage employees who get housing benefits to contribute to their rent.
Yeah.
Even a small amount can make a big difference in their overall tax liability.
So it's all about finding that balance,
Right.
right? Give a great benefit, but do it in a way that makes sense for everyone's taxes. What else?
Housing allowances. If they provide a housing allowance within the tax-free limit, which is currently 36,000 shillings per year, it's a win-win.
That's a great tip, especially for companies that might not be able to, actually provide a house, but still want to help out with housing costs. It seems like there are actually quite a few options if you know what you're doing.
Absolutely. It all comes down to understanding the system and picking the best strategy for the company and the employees.
Okay, so we've covered a lot on housing benefits. Now, I know lots of people depend on things like employer-provided life insurance, so I think understanding how that works with taxes is really important. Let's talk about that next. So we've talked about how even something like a housing benefit can have these tax implications. Now, let's switch gears a bit and talk about life insurance, something I think a lot of people rely on. Employer-paid premiums are a pretty common perk, but it looks like they can be a little bit of a headache when it comes to taxes.
Yeah, you're right. Life insurance is a big part of a lot of benefit packages, but the tax side of things can be tricky.
Okay, tricky. I like tricky. Lay it on me.
Well, the good news is that even though employer-paid life insurance premiums are usually considered taxable income, there are a couple of big exceptions.
Okay, exceptions are always where things get interesting. Tell me more about these exceptions.
So the first one has to do with, saving for retirement. Any premiums that your employer pays into a registered pension scheme or a pension fund or like an individual retirement fund, those aren't considered part of your taxable income.
Ah, okay, so it's like a double bonus for retirement savings, right? You're putting money away for the future and you're also getting a tax break now. Smart.
Exactly. It's a win-win for everyone involved.
Okay, so retirement contributions are a big one. What's the other exception?
The other exception is for group life policies. Specifically, if your company has a group life insurance plan where the payout doesn't directly benefit you or your family, then the premiums your employer pays are also excluded from your taxable income.
So it's like a company-wide safety net, and it doesn't hit the employees with extra taxes. But how do they decide if it directly benefits the employee or not? That seems kind of fuzzy.
Yeah, it's a good question. It really depends on the specifics of the policy and how it's set up. For example, if the death benefit goes to the company itself instead of an employee's family, it would probably fall under this exception.
I see. So it's about who ultimately gets the money from the policy. Okay, that makes more sense. So we've covered housing and life insurance premiums. What other employee benefits have, these interesting tax implications in Kenya?
Well, the document specifically mentions club fees, like for entrance and subscriptions. If your company pays those for you, it's considered taxable income.
Club fees. Really? That seems kind of random.
I know, it sounds a little strange at first.
Yeah.
But it makes more sense when you think about it this way. Anything that an employer gives you on top of your regular salary is basically part of your overall pay package.
Oh, okay. So even if it's not cash, it's still something of value that I'm getting, and they're
Yeah.
going to tax that value.
Exactly. They're recognizing that these perks have a monetary value, even if it's not as direct as a salary increase.
So let's say a company wants to, help their employees be healthier, have a better social life. Are there ways to do that without triggering these extra taxes? Would it be better to, I don't know, like have a company gym instead of paying for a fancy club membership?
You're totally on the right track. The document actually suggests that wellness programs could be a good alternative. Things like on-site fitness centers, health workshops, mental health services. Those are more likely to be seen as promoting employee well-being and might not have the same tax implications.
So instead of paying for that country club membership, maybe they put in a gym at the office or offer yoga classes. Seems like a good idea all around.
Right. It's a win-win. Employees stay healthy, and the company might be able to avoid some tax headaches.
Speaking of avoiding headaches, is there like a general rule that employers can use to figure out the tax side of different benefits? It feels like there are so many specific rules.
I know, it's a lot to keep track of. But the document does have a general principle that can help.
Hmm.
Basically, they say the taxable benefit of, well, any benefit is going to be the higher of two things, either the cost to the employer for providing it or the fair market value of that benefit.
So it's like whichever number is bigger, that's what they're going to use.
Yeah, pretty much.
But I'm guessing it's probably not always that straightforward in practice.
You're right. There are always details to consider. Like we saw with housing, there are different rules and calculations for different types of benefits. That's why it's always a good idea to talk to a tax professional, just to make sure you're doing things right.
Good advice. Before we move on, there are two more benefits I was curious about: employee share ownership plans and company cars. I feel like those could have some pretty big tax implications.
Oh, absolutely. Those can both be tricky areas. With the share ownership plans, the tax is all about the difference between what the shares are worth when you buy them and the discounted price you got. So if the shares have gone up in value since you got the option to buy them, you could have a big tax bill.
So you might be making a great investment, but you got to be ready to pay the taxes on those gains.
Right. And with company cars, things get a little weird. The taxable benefit is based on what the car cost originally, not what it's worth now. And get this, that taxable benefit actually goes up over time.
Hold on. So the longer they have the company car, the more they get taxed on it.
Yeah, it's a bit counterintuitive, right?
Yeah.
But it's because they're getting a bigger benefit over time as the car depreciates.
I see. So it's like a built-in depreciation factor for the tax man. Not so great for the employee, though.
Exactly. It just shows how important it is to think about the long-term tax implications when you're deciding about company vehicles.
Okay, so we've gone over housing, insurance, club fees, share plans, and even company cars. It's pretty clear that Kenya has a lot of rules when it comes to employee benefits and taxes.
It's a complex landscape for sure. But if companies and employees take the time to really understand the rules, they can make smart choices that benefit everyone.
Well said. Okay, there's one more area we need to talk about before we wrap things up. Employee loans. The document mentions those specifically as having some potential tax traps. Can you break that down for us? So, employee loans, what's the deal with those?
Well, the thing about employee loans is that they can trigger something called fringe benefit tax if the company offers them at a lower interest rate than, what you find out in the market.
Fringe benefit tax. Okay, that's a new one. Why is a lower interest rate considered a taxable benefit? It's not like they're getting free money.
You're right. It's not free money, but the idea is that the difference between the market interest rate and that lower rate the company's offering is like a financial advantage for the employee.
Ah, so they're getting a break on the interest, and that's seen as a perk that needs to be taxed. Makes sense.
Yeah, it's all about recognizing that even though it's not a direct cash bonus, that lower interest rate is still a form of compensation.
Mm.
And, the document really emphasizes that if companies aren't really careful about calculating and reporting this correctly, they can get in trouble with the tax authorities.
Yikes, nobody wants an audit. So how do they even calculate this fringe benefit tax? It sounds complicated.
It can be, yeah. But the main thing to remember is that offering these loans at a discounted interest rate can create a bit of a tax headache for everyone involved.
So it's not just about being nice. Companies need to be smart about how they structure these loans. Are there any ways they can, minimize that tax liability?
Definitely. The easiest thing is to just use the market interest rate. As of October 2024, that rate is 12%. So if companies charge at least that much, they can usually avoid the FBT altogether.
Oh, that makes sense. No special discount, no fringe benefit, no tax. What are some other strategies?
Another approach is to put limits on the loan amounts,
Yeah.
especially for those interest-free or low-interest loans. By keeping the loan size smaller, they're also limiting that potential tax hit.
Smart. Any other ideas?
The document also mentions that short-term loans can be helpful, or loans that are, tied to how long the employee's been with the company. That way, if the loan gets paid off quickly or ends when the employee leaves, it minimizes the long-term tax implications.
Okay, so it's all about being proactive and thinking ahead about how these loans might impact taxes down the road. Man, it seems like taxes touch everything.
I know, right? But hey, with a little bit of knowledge and careful planning, it's definitely manageable.
Well, thank you so much for walking us through all of this. It's been really helpful. And for everyone listening, we hope you've enjoyed this deep dive into employee benefits and taxes in Kenya. It's a complex world, but hopefully this has given you some valuable insights. Until next time, happy exploring.